Welcome back to Talk Tickers, everyone.
Hey, glad to be here.
Yeah, so today we're jumping into a brand new deep dive, and this one is honestly fascinating.
It really is.
We are looking at a microcap hardware company, ticker symbol OSS, One Stop Systems, and basically they've somehow positioned themselves at the exact center of the two biggest macroeconomic trends on Earth right now.
Right, defense modernization and, of course, artificial intelligence.
Exactly. So for you listening, our mission on this deep dive is to unpack their latest Q4 earnings. We're going to break down how a company pivots to a pure play strategy, figure out what rugged edge AI actually means in the real world, and, talk about why their stock saw such crazy volume and volatility recently.
The market reaction was wild. But I think the real story here is execution.
Oh, 100%. But before we get to the numbers, I want you just to imagine something. Think about a top-of-the-line gaming PC.
Okay.
The kind with huge GPUs, crazy memory, liquid cooling, the works. Normally, that sits on a desk in a nice, cool room, right?
Right, totally safe.
Yeah. But now imagine you take that exact same supercomputer, bolt it into a metal box, and, I don't know, drop it out of a military aircraft.
Just casually out of an airplane.
Exactly. Or you weld it to the inside of an army tank that's just bouncing around over, IED craters in the desert.
Yeah.
And while that's happening, this machine still has to process complex AI data instantly.
Without crashing, which is a borderline impossible physics problem.
Exactly. And that is what OSS builds. So we're going to get into all the battlefield tech, the commercial applications, and their whole strategy. But first, let's start with a quick snapshot of the results because they absolutely shattered expectations.
They really did. I mean, it was a massive quarter.
So Q4 revenue came in at $12.0 million.
Which is huge.
Yeah, that's a 70.2% year-over-year increase. And it just crushed the street consensus, which was sitting at around $10 million.
Right, so we're talking about a 20% top-line beat. And in the microcap space, a beat like that is, it's basically a seismic event.
Oh, absolutely.
It forces every analyst to just tear up their models and start over.
Totally. And the EPS was just as good. JAP EPS hit 8 cents, beating the 3-cent consensus.
Mm-hmm.
But the number that is just completely insane to me is the gross margin. They hit a record 58.5% gross margin.
Which is a software number. You don't see that in hardware.
Right. A year ago, it was 9.4%. So jumping to 58.5 is just ridiculous.
And obviously, the market went nuts. The stock gapped up right at the open. It went from, 99 pre-market to closing at 11.24?
Yeah, up 12.5% intraday.
But the volume is what really caught my eye. They traded almost 5.85 million shares.
Which, just for context for you listening, their normal average volume is under 1 million shares, 900,000.
Yeah, so that's over 6 times the normal daily volume.
Yeah.
That is institutional money waking up and realizing what this company is doing.
Exactly. And over the last year, the stock is up 221%. It's just crushing everything else. But look, a great earnings print is one thing. To understand how they actually achieve those margins, we have to talk about the bank account.
Right, the strategic shift.
Right, because right before 2025 ended, on literally December 30th, they completely changed their financial identity.
They did. They finalized the sale of their subsidiary, Bressner.
For $22.4 million, which, okay, I got to push back on this a little bit.
Sure.
If I'm a business and I'm telling Wall Street I want to grow my revenue, why on earth am I selling off a huge revenue-generating piece of my company? It seems so backwards.
I mean, it does feel counterintuitive at first. Why shrink to grow?
Right. If I own a bakery and a shoe store, I don't burn down the shoe store to make the bakery look better.
Well, you do if you're trying to take the bakery public and investors only want to buy pure play bakeries.
Okay, fair point.
It's all about portfolio simplification. Bressner was this legacy asset. They bought it back in 2018 for, I think, $5.6 million.
Okay, so selling it for 22 is a huge win right there.
Exactly. Fantastic ROI. But Bressner was basically a standard European IT distribution business. It wasn't rugged AI.
Wasn't the sexy military tech we're talking about today.
Not at all. And narrative dilution is a real penalty on Wall Street. If a portfolio manager looks at OSS and sees European IT distribution mixed with U.S. Navy AI servers...
It's just too confusing. They pass.
Exactly. So by selling it, they become a highly focused, pure-play, rugged AI company.
And pure plays get higher valuation multiple.
Exactly. Plus, look at what it did to their balance sheet. They ended the year with $31.2 million in cash.
Wow.
Another $2.2 million in restricted cash. And crucially, absolutely zero debt.
Man, zero debt right now is a superpower.
It really is, especially with how high the cost of capital has been. They don't have interest payments eating up their cash flow. They can actually afford to take risks and heavily fund their R&D.
Right, and their working capital shot up too, didn't it?
Yeah, up to $45.3 million. A lot of that was the Bressner cash, obviously, but they also saw a massive spike in accounts receivable, like a 176% increase.
Which usually makes me nervous. Like, are clients just not paying?
In retail, maybe. But here, that AR spike is just a mechanical result of that huge Q4 revenue beat. They shipped a ton of product late in the quarter.
So the invoices went out, but the cash just hasn't hit the bank yet?
Exactly. And we're talking about invoices to Tier 1 defense contractors. The U.S. government is going to pay its bills.
Yeah, that's incredibly high-quality AR.
Right. And having that $45 million in working capital means they can pre-purchase parts. Like if there's a memory chip shortage, they have the cash to just buy what they need up front so they don't miss military deadlines.
Which leads us right back to that insane 58.5% gross margin. You said earlier it's a software number. How does a hardware company actually pull that off?
Well, to be fair, the prior year's 9% margin was artificially low because of a contract loss charge.
Okay, so it wasn't quite as bad as it looked.
Right. The adjusted margin back then was around 26.8%. But still, jumping from 26 to 58 organically in 1 year is massive.
So what's the secret?
It's mostly product mix. They made a very deliberate choice to stop chasing cheap, low-margin server boxes.
Because anyone can bend a piece of metal, right?
Exactly. It's a race to the bottom. Instead, they're selling highly complex, proprietary cooling and compute solutions. When a defense prime needs a server to survive a war zone, they aren't haggling over a few percentage points of margin.
Right, they're paying for survival, they just need it to work.
Exactly. And the other factor is just scale. When you do $12 million of revenue in a quarter, your fixed costs like your rent and your base engineering salaries get spread out over a much larger number.
So every extra dollar of sales drops almost straight to the bottom line. Okay, so the financials are pristine. But, you know, a good bank account doesn't actually win military contracts.
No, it definitely doesn't.
So let's get into the actual technology here. Let's talk about rugged edge AI and what they're actually building for the battlefield. Because this is the cool part.
It's fascinating. So for the last decade, everything was about the cloud, right?
Your phone collects data, sends it to an Amazon server farm in Virginia. The server thinks about it and sends the answer back.
Right. But at the edge, the cloud is useless. If you're flying a submarine hunting jet over the middle of the Pacific Ocean...
You don't have Wi-Fi.
Exactly. You don't have a fiber optic cable to an air-conditioned data center. The compute has to happen right there, physically on the jet. That's the edge.
And it has to be rugged because a normal server would just shake itself apart.
Literally vibrate to pieces. The crazy thing is the amount of data these vehicles generate now. It's not just GPS coordinates anymore. It's high-def video, thermal imaging, radar, acoustic sensors all running at once.
Which requires massive AI processing power. And I saw they introduced a new PCIe Gen 6 portfolio in Q4 specifically for this.
Yes.
Okay, so for those of us who aren't, computer engineers, what does PCIe Gen 6 actually mean? Why is it such a big deal for AI?
Think of it like a massive construction site. The CPU is your site manager. The GPUs are your thousands of workers doing the actual heavy lifting of the AI math.
Okay, tracking.
The PCIe is the highway system that connects the manager to the workers.
So if you have super fast GPUs, but the highway is a dirt road.
The workers are just standing around waiting for instructions.
Exactly.
The bottleneck in AI right now usually isn't the processor, it's the data highway trying to feed it.
So Gen 6 basically turns that dirt road into a 10-lane superhighway.
It literally doubles the bandwidth of the previous generation. It feeds the GPUs constantly.
And doing that inside a ruggedized military-grade box is the real trick.
Oh, it's incredibly difficult, which is why their contracts are so sticky.
Yeah.
Let's look at the P-8 Poseidon program.
Yeah, I wanted to ask about that. They have, $65 million in total contracted revenue for that one jet?
Over the lifespan of the platform, yeah. And they just announced another $10.5 million in new awards starting in 2026.
So just to paint a picture for you listening, the P-8 is a U.S. Navy jet that hunts submarines. It flies over the ocean and drops these little sonobuoys into the water.
Right, acoustic sensors.
And those sensors are picking up every single noise in the ocean. Whales, cargo ships, waves crashing.
It's a massive amount of raw audio data.
And The AI has to filter out the whales and the waves instantly and find the exact sound of a hostile nuclear submarine's propeller.
While flying hundreds of miles an hour.
It's insane. And the hardware doing that math is just getting slammed with G-forces and vibration inside the plane.
If that OSS server fails, the jet goes blind and deaf. The mission is over.
Which explains why the Navy just keeps handing them millions of dollars. The tech is absolutely mission critical.
And we're seeing that exact same mission-critical dynamic on the ground, too. In January, they announced a new win with a major prime contractor for U.S. Army combat vehicles.
Right. And you were explaining this to me earlier, but basically, modern tanks are just rolling steel boxes, right?
Yeah, they're heavily armored, but visibility from the inside is notoriously terrible. You're trying to look out of these tiny little periscopes.
Which seems really dangerous if you're in a combat zone.
It is. So this new program uses GPU-accelerated sensor processing to give the crew a full 360-degree enhanced view of the outside world.
So they put cameras all over the outside of the tank.
Cameras, thermal sensors, everything. And the OSS compute system ingests all that video in real time, processes it through the AI to instantly spot threats or obstacles, and feeds it to the crew inside.
Like giving them X-ray vision through the armor.
Essentially, yes.
Yeah.
And they mentioned this is a totally separate initiative from another 360-degree system they're already testing. This new one starts testing at the Army Ground Vehicle Center in late 2026.
And this is huge for a microcap company because the Army doesn't buy tanks one at a time.
No, they buy them by the hundreds or thousands. If this gets written into a formal, funded program of record across a whole fleet, the revenue is transformative.
Right. They also highlighted a deal with Safran Federal Systems, right? A $1.2 million follow-on order.
Yeah, for these rugged 4U short-depth servers.
Yeah.
And management expects that relationship to exceed $7 million over the next 5 years.
So all of these programs, the jets, the tanks, Safran, they all highlight what you call the program moat, right?
Yes. The program moat is the holy grail in defense contracting.
Explain how deep that moat actually is. Like, why can't a competitor just come in and offer the Army a cheaper server next year?
Because the barrier to entry is practically impenetrable. To get your hardware onto a military platform, you have to go through years of prototyping, brutal environmental testing, and crazy security certifications.
It takes forever.
It does. But once your server is written into the official spec sheet for that tank, you are locked in.
Because the military doesn't want to start over.
Exactly. If they swap out the OSS server for a cheaper one 5 years from now, they have to completely recertify the entire tank's electronic system. It's too expensive and takes way too long.
So they just stick with OSS. It's guaranteed recurring revenue.
Right. But here is where OSS's strategy goes from being just a good defense business to genuinely brilliant.
The commercial crossover.
Yes. The commercial flywheel.
Walk us through this because this blew my mind when I read it. Who pays for what in this flywheel?
Okay, so it starts with the military. They come to OSS with an insane physics problem, like we need a liquid-cooled AI server that can survive getting blown up.
Right.
The military actually pays OSS millions in R&D grants to figure that out. So the riskiest, most expensive part of product development is subsidized by the taxpayer.
Wow.
OSS develops the tech, perfects it on the military's dime, but they get to keep the core intellectual property for the cooling and ruggedization.
And then they just turn around and sell that exact same battle-tested tech to commercial companies.
Exactly. They adapt it for commercial use cases that are really demanding, but slightly less lethal, and sell it at a massive markup.
That is such a cheat code. Let's talk about the medical imaging deal they mentioned, because that perfectly illustrates this.
It really does. They got a $2 million follow-on order from a major medical imaging OEM.
For liquid-cooled systems used in breast cancer detection.
Right. And management thinks this one program will do over $25 million in the next 5 years.
Which is a huge jump. $2 million to $25 million means this thing is going into full production.
Exactly.
But I got to ask the cynical question here.
Go for it.
If I'm a massive conglomerate like GE or Siemens, I have billions in R&D, why am I hiring a tiny microcap defense company to cool my medical scanners? Can't I just build a PC myself?
You'd think so, but thermal management at the edge is incredibly niche. Think about what modern medical imaging actually is. It's not just taking a photo anymore.
Right, it's heavy AI inference.
Exactly. The AI is looking at the scan in real time while the patient is in the machine trying to spot microscopic anomalies. That requires huge GPUs right there in the hospital room.
Because you can't just upload a massive, highly sensitive medical file to the cloud. IPA regulations alone make that a nightmare.
Plus the network latency. So the compute has to be local, but when you put 4 massive GPUs in a hospital cart, they generate insane amounts of heat.
Oh, I see. And normal air cooling means fans.
Huge high RPM fans that sound like jet engines. You can't have a machine screaming at 90 decibels in an oncology ward where a patient is already terrified.
No, that would be awful.
So OSS takes the totally silent, highly efficient liquid cooling tech they built to keep military servers from melting in the desert.
And they stick it in the hospital cart.
Exactly. It keeps the AI running at peak performance totally silently. GE knows imaging. OSS knows edge thermal management. It's a perfect match.
That is just brilliant. They also mentioned a big win in commercial aerospace, right?
Yeah, an initial $1.5 million order for passenger cabin lighting and control systems.
And they expect that to be about $6 million over 3 years. But the key detail there was this DO-160 qualification. What is that?
DO-160 is basically the gold standard for environmental testing in aviation. It's literally a torture chamber for electronics.
Like, what do they do to it?
They subject the hardware to explosive decompression, extreme temperature swings from sub-zero to boiling, crazy vibration profiles simulating heavy turbulence, and even simulated lightning strikes.
Good grief, just to make sure the cabin lights don't break.
Well, the hardest part is actually the electromagnetic emissions testing. You have to prove that turning on the LED lights doesn't emit a frequency that scrambles the pilot's navigation instruments.
Oh, wow. Yeah, that makes sense. You don't want the plane diving because someone turned on a reading light.
Exactly. So getting DO-160 qualified is incredibly hard. But once you have it, companies like Airbus or Boeing know they can trust you. And those contracts last for 10 or 15 years.
Right. And they're doing the same thing with autonomous robotics now, too. They displaced a legacy provider to put their compute systems in autonomous mining equipment.
Which is another brutal environment. A driverless dump truck in a mine is dealing with dust, constant vibration, extreme heat.
And it relies entirely on LiDAR and cameras to not run over people.
Exactly. It's the exact same AI physics problem as the Army tank, just applied to a commercial mining site.
Okay, so up to this point, for you listening, this all sounds like a flawless victory lap. Record margins, zero debt, huge medical contracts, AI on the battlefield.
That sounds perfect.
Right. But we said at the beginning, the stock chart was super volatile on earnings day. It swung from $9.40 up to $12.21.
Yeah, algorithmic whiplash.
Exactly. Wall Street wasn't just blindly euphoric. So let's talk about the catch. What were the tactical caution flags hidden in their 2026 guidance?
Well, the friction came entirely from how they structured that 2026 guidance. On the surface, it looks great. They projected 20 to 25% top-line growth.
Which means roughly $38.7 to $40.3 million for the year. That's solid.
Very solid. And they guided for gross margins to stabilize around 40%.
Wait, 40%? Didn't they just hit 58.5?
They did, but they're guiding down to 40 because the product mix is going to normalize. They have a lot of those customer-funded development programs ramping up this year.
And those carry lower margins initially.
Right, but they pave the way for the high-margin volume production later. So 40% is still great for hardware.
Okay, so revenue's growing, margins are solid. What actually spooked the day traders?
It was the timing. The entire year is heavily back-half weighted. Management said to expect only 40% of the revenue in the first half of the year and 60% in the second half.
Okay, a 40-60 split.
But the real trigger was they explicitly told investors to expect negative EBITDA in the first half of the year.
Yeah, if I'm a retail investor and I hear a company fresh off a huge beat say, hey, expect negative EBITDA for the next 6 months, I'm hitting the sell button.
Of course, because negative EBITDA means you're burning cash.
Right. So is this a structural flaw in their new pure play model, or is this just a timing thing?
It is overwhelmingly a timing and supply chain issue. Look at the demand side first. They cited a book-to-bill ratio of 1.2x.
So just to clarify, a 1.0 ratio means you're shipping products exactly as fast as new orders come in.
Right. So at 1.2, for every dollar of product they ship, they're getting $1.20 in brand new orders.
So demand is off the charts. The military and hospitals are begging for this stuff.
Unequivocally. The problem is actually converting that massive backlog into recognized revenue.
Then why can't they? What's the holdup?
Extended lead times for memory chips.
Oh, of course. The global semiconductor bottleneck.
Exactly. The huge AI data centers being built for, like, ChatGPT and Gemini are sucking up all the global high bandwidth memory.
And OSS, being a microcap, is kind of at the mercy of that supply chain.
They are. They've diversified their suppliers, but they still have to bake those delays into their guidance. They can't book the $1 million military contract until they physically get the memory, build the server, and ship it.
Which pushes all that revenue into the second half of the year.
Right.
But wait, that explains why revenue is lower in H1. It doesn't really explain dipping all the way into negative EBITDA. Why are they burning cash?
That comes down to their R&D spending. They guided for overall R&D to be about 10 to 12% of annual sales. But they're cramming 60% of that total expense into the first half of the year.
Why intentionally front-load it like that?
Because of those military contracts, the Army tank program, the Navy jets. They have strict, contractually obligated design milestones they have to hit right now.
So they're paying their engineers overtime, essentially, to hit these deadlines.
Exactly. They are willfully taking the hit on engineering payroll today to guarantee those multi-year production revenues tomorrow.
Ah, okay. So you combine lower physical shipments because of the memory shortage with super high front-loaded R&D expenses.
And the math equals negative EBITDA in the first half.
Got it. So the takeaway here for listeners is you have to be patient. If you want a stock that just goes up linearly every single quarter, this is going to drive you crazy.
Absolutely. But the professional sell-side analysts completely understand this.
Right. Lake Street raised their target to $12 and kept a buy rating right after the call. Alliance Global went up to $13.
They called it a better-than-expected quarter. They know that 2027 is when all these development programs finally mature into full production.
So the initial stock drop that morning was probably just trading bots, seeing the words negative EBITDA and dumping it.
Almost certainly. And then human analysts actually read the transcript, saw the book-to-bill ratio, and bought the dip hard.
Okay, so they're waiting on memory chips, and they're paying their engineers to build prototypes. But we have to remember, they're sitting on $31 million in cash from the Bressner sale.
Yes, the war chest.
What is management going to do with that cash?
Well, Mike Knowles, the CEO, was very transparent. He said M&A activity has picked up significantly. They're actively looking at hardware-adjacent and selective software targets.
And software is the key word there, right?
That is the absolute magic word for their long-term valuation. Right now, OSS makes incredible, indestructible metal boxes.
Best-in-class hardware.
But it's still just hardware. The customer only buys a box once every few years. There's a ceiling on hardware margins.
Right.
But if they buy a software company, say, the actual AI operating system that manages all that sensor data on the tank.
Or the specific algorithm that filters out the whale noises for the Navy.
Exactly. If they can offer a fully integrated edge AI platform, hardware and software combined, their valuation paradigm changes overnight.
I stop being valued like a hardware store and start getting valued like a tech platform.
Right. Wall Street pays a massive premium for software because the margins are insane and it's recurring subscription revenue. You write the keg once and you sell it forever.
So if they layer software margins on top of their military moats...
Their corporate margins could blast right past that 58% mark.
But they did say they're going to be disciplined, right? They aren't just going to buy something just to buy it.
No, which is what you want to hear. They just proved they know how to sell a company well with Bressner. Now they have to prove they can buy intelligently.
Okay, so let's summarize all of this because we've covered a ton of ground today. OSS sold off their legacy IT business to build a fortress balance sheet with zero debt.
They're driving 70% revenue growth with massive margins.
They are deeply entrenched in defense programs, jets, tanks, and they're spinning that tech out to commercial hospitals and autonomous mines.
But you have to stomach the back half-weighted 2026 guidance and the global memory chip shortage.
Right. It's a company that sold its past to fund its future. Now, before we get to our final segment, I want to leave you with a provocative thought based on all this.
Let's hear it.
We talked about how hard it is to build a computer that survives falling out of a plane. But over the next 10 years, as AI gets better and better, the actual physical hardware might start to become commoditized.
Right. Eventually, anyone might be able to bend the metal.
Exactly. So the real question is, does OSS know this? Is their push into software M&A a sign that they realize the ultimate defense moat in the future isn't the physical server box?
It's the invisible AI operating system running inside the box.
Just precisely. That's the multi-million-dollar question. All right, to wrap things up, we always like to look at the market from a tactical angle. So welcome to our This Is Not Financial Advice segment.
My favorite part.
Remember, this is just an exploration of market mechanics, not a recommendation to buy or sell anything. But looking at these wild intraday swings and the weird 2026 guidance, how would a hedge fund actually trade this?
Well, if I were pitching a portfolio manager right now, I'd look at a calendar spread strategy. We know management has telegraphed negative EBITDA and slow revenue for the first half of the year, right?
Right, they literally warned everyone.
Yeah. But the retail market has the memory of a goldfish. When OSS actually prints a negative EBITDA quarter in May, people might panic and sell off the stock, even though it was expected.
So you bet on the market overreacting to the bad news we already know is coming.
Exactly. You buy near-term put options or selectively short the stock to capitalize on that first half weakness and investor fatigue.
Okay, and then what? How do you play the second half?
You use the profits from that short-term downside play to fund a massive upside bet for the back half of the year. You buy long-dated call options for 2027.
Because by Q3 and Q4, the memory chips arrive, the R&D is paid for, and the revenue explodes.
Exactly. The narrative flips completely. It's a classic time arbitrage trade. You're betting that the market's attention span is too short to handle the messy first half, so you position yourself for the massive fundamental wave in the second half.
That is brilliant. A highly tactical play based directly on the company's own guidance. I love it. All right, well, that wraps up today's deep dive on stock tickers.
Thanks for having me.
Always a pleasure. For everyone listening, thank you for joining us. Keep questioning the data, keep looking for the real story behind the headlines, and we will catch you on the next one.